You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. Welcome back to Education Wednesday, a very special Education Wednesday. If you're listening to this on demand, it won't sound like anything different to you, but if you're one of our pro members, you're getting another special doubleheader of Options Bootcamp. We love bringing these to you. It's always fun. 2 episodes back to back. No waiting, right into the heart of the matter. 2 episodes back to back. Can't beat that. Of course, if you want to join the live fun for this show, for everything else, you don't want to wait a week for the next episode. You also want to get exclusive pro Q&A sessions with all the top minds in the world of options and derivatives, as well as, of course, Options Oddities every Friday, where we break down the crazy trades that went on that week. We also maybe put on some crazy trades of our own. We let you guys talk us into all sorts of crazy stuff, as well as give you guys a whole bunch of free stuff to the giveaways. The next pro trading crate is going out soon. So get your name in the hat. How do you get your name in the hat to win that? theoptionsinsider.com/pro, or for all you cool kids out there, /secret club. Of course, also get your access to the live. As we're recording this, listeners, on the special doubleheader, I see a lot of our chatting about the hurricane that is hitting and making landfall in Florida right now. I know some of our live listeners are based out of Florida. In fact, I don't see some of them in the live chat right now, so I hope you folks are all doing well, battening down the hatches there. Hopefully you got the heck out of Dodge ahead of this thing. It's supposed to be a pretty nasty storm. Hopefully all our folks down there in the southern reaches there are doing well. Maybe we'll provide you with some information and a little bit of distraction for all the madness that is going on out there. And joining me to help provide said information and distraction. What did our reviewer say last week? It was options and fun in equal measure. Our reviewer this week is, of course, the interestingly named KKFLO. He just says, sub now, enough said. I like that. Enough said, an old Stan Lee reference. Good stuff. So if you want to join what he's talking about, get on over there to whatever store you listen to this on, whatever platform you get the show on. Keep the 5-star reviews coming. Clearly, it helps new folks discover the content all the time. And unfortunately, when they discover the show, that means they also discover my cohort, my partner in crime, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir. Enough said.
It is wonderful to be here, Mark, and I'm looking forward to this segment.
Well, I am as well, so let's get right to it. A little bit of the old options drills.
Well, in bunch, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills. Like the man said, this is the portion of the show where we explore some interesting ways to utilize options and maybe the proper way you should be utilizing them in your portfolio, some tips, some tricks we have for you along the way. And Dan, we've been getting a lot of feedback lately about flies, about butterflies, when to use them, when to not use them. So it seemed like a perfect time to review that on the show, Dan. When to use a butterfly and when not. What do you think, sir?
Well, first of all, I think it's going to be a great episode, maybe the best episode ever.
Ooh,
Okay,
I like that enthusiasm, sir.
Yeah, I mean, I might be overselling a little bit, but it's going to be a good one because this is important. I feel that for any option trader, I always tell people, hey, try and get good, really, really good at one type of strategy, but you can't just rely on one. One trick ponies never last. Then move on and learn another and learn another. And this is one that has its own little plot of land in the options landscape, and it'll take you far at the right time on the right stock.
There are quite a few butterfly proponents out there. We've touched on them many times in the long 10-plus year history, 200-plus episodes now here. I believe this is episode 206, so we're already rolling well past the 200 mark here. So go back into the archives, look for, obviously, episodes about butterflies, also spreads with wings and other types of trades like that. We have discussed butterflies many times. Quick refresher. We've been talking about a lot of spreads with wings lately on the show, but the butterfly is kind of the mother of them all. The butterfly is kind of really the spread with wings to rule them all out there. Let's go back to our old friend XYZ. XYZ, once again, trading at 50. Once again, I'm going to approach this example from the long side, because that's usually easiest for people to wrap their heads around that way. Dan, I know, black-hatted one, he likes to go from the short side, so we can flip this example around and explore it that way as well. But let's start off. XYZ's trading at 50. Look at it from an upside perspective. You think it's going to rally, but you don't really want to pay through the nose for an upside position. Well, that's where the butterfly might be an interesting one for you to explore. In our example, we're going to go 10% out of the money, and you're going to buy a 1-month call, 55 strike, for $1. So that's actually a pretty decent move, all things considered. You expect it to move 10% in a month. But then you decide, you know what? It's definitely not going to make it to 60 by the end of the month. So why should I sit on all this premium I just paid for this thing? So I'm going to turn around and I'm going to sell not one, but two. I'm going to sell two of these 60 strike calls now. And in our example, you paid $1 for the 55 call. In our example, a 60 call is trading for 50 cents. And you just sold two of them. So guess what? You paid $1. You just collected $1. You're flat on this trade. But now you're saying to yourself, wait a minute. I listen to Mark and Dan. They always tell me never to have naked risk. I am now long one and short two. So I have naked risk to the upside. I am short an extra call to the upside. We all know being short and underlying is infinite risk. You don't want that in your life. So you decide, you know what? I listen to Mark and Dan. I'm going to cap that risk against me. I'm going to come back now and buy the 65 call. So we're keeping everything symmetrical, no funky broken wings or anything like that. And you buy one of the 65 strike calls. And in our example, you pay 25 cents for that. So what have you done now? Stock's at 50. You want it to pop a bit. So you're by the 55 strike call. You're expecting a decent move, but nothing earth-shattering. So you turn around and sell two of the 60 calls. You paid $1. You sold two for 50 cents. You're net flat now, but you don't want that short risk. So you buy one 65 strike call and you pay 25 cents for that in our example. So your net outlay now for all of this that you've done is now 25 cents. So you can look back and the first benefit of the butterfly is now pretty obvious. Instead of paying $1 for the 55 call, you have effectively paid 25 cents for that. And so that's a nice thing. Of course, you have capped your upside there. Once you start getting past the 60 strike, things start coming back to bite you. And of course, you've limited all your risk at that 65 strike out there. So at the end of the day, this is a long premium trade. It's risk mitigated. So at the end of the day, the worst you can do with this is give up what you paid for that spread, which in this case is 25 cents. So it's a fairly low risk swing at the bat as well, which is also attractive to people. You're coming in, everything's very much defined for you at the outset. You're looking exactly what you have. You know exactly where your break evens are. In this case, the ideal scenario for this butterfly, which is the case with most spreads. In most spreads, you want the underlying to go right to your short strike and then sit there and never move again. That would be the ideal thing for most option spreads. So in our example, we're short two of the 60. So in this, it would be fantastic. You bought the 55s, the underlying goes straight to 60 and then sits there. Why is that great? Well, you get your maximum value of that spread that you bought. It's a $5 spread. It's sitting at its max value of $5. You're sitting right at the 60 strikes. Remember, we talked about last week, at the money is where the decay is the most aggressive. So your 60 calls are going to decay very rapidly. You're short 2 of them. So that's a great thing. And then it's not going to move any farther than that, which every tick above 60 is going to start costing you money and eating into that $5 profit that you made on that spread. So actually $4.75 because you paid 25 cents for this spread. So a lot of things are very attractive about the butterfly. They're very low cost, risk mitigated ways for you to get exposure to different underlyings. The downside, of course, is that you are capping your profit potential on these types of trades. So it's not an unlimited. You buy that 55 call for $1. The sky's the limit for you. I mean, you're paying a lot for that. But on the flip side, this thing could go to 100. It could be another GameStop, and you will capture all of that. So that's the downside of the butterfly. You're not going to play above that top strike. That's really where you're kind of stopping yourself out there. Now, Dan likes to be a dark side guy. I don't think you'd like our example very much because you're not really getting a lot for this. You're selling $1, you're paying $1, and then on top of that, you're selling 25 cents more. So 25 cents, I'm guessing Dan probably would not do this for 25 cents. But Dan, explain to our listeners, why do you prefer a short fly versus a long fly, sir?
Well, Mark, I like the short fly better than the long fly because especially if we're doing these at the money, right? If we're doing these at the money as sort of like to try and take advantage of a sideways stock, by selling the butterfly. The thing is if you buy one and you're buying the guts at the money, which is that center strike, your theta just like grows and grows and grows. And it's like, you better be right. And you better be right fast. Unless you give yourself a lot of extra time until expiration, where your theta will stay, fairly flat, close to zero, but then big deal, you get that move and nothing major really happens. Now, I actually want to do yet another contrast. On our last episode, we talked about iron butterflies versus straight butterflies. And I usually prefer the iron butterfly when I'm trading the guts at the money, because you typically will get wider bid-ask spreads because the wings are always out of the money options. Now, let me go into. Do you mind if I just kind of dive into this long iron fly example, Mark?
Go to town, sir.
Okay, so look. Let's use Mark's favorite stock and my favorite stock, XYZ, which is trading at $50, if you can imagine that. For those of you who use time at price, man, XYZ at $50, it's just a really long, big old spike on the chart there.
Screaming bargain. You got to buy it. I'm long a few million shares myself, but that's an aside. Neither here nor there.
Right. So, we think the stock is not going to move, right? If we think the stock is not going to move, what we would be doing here, let me see here. I'm just looking at my notes here. We would be basically, where did it go? Oh, I don't have it on my notes. Yeah, you would be basically selling 2 at the money calls and then buying one in the money call and selling one out of the money call. So, basically what you're doing there in that case is I like to do these directionally myself. Yeah, I like to do these directionally. Because when you do them directionally using calls, I would use all higher call strikes and just set a target at the apex there, at the guts price. Because then if all the options are out of the money, then we don't have those terrible bid-ask spreads to worry about. And then we basically trade it as a call debit spread financed by a call credit spread, just sharing one of those strikes. And, we never plan to have it be like, we never expect it to end up exactly at the money of the guts. We always just want it to be somewhat in that range. So, that does kind of, not demystify, what's the word I'm looking for? De-romanticize the amazing looking risk reward that we often see on some of those butterflies like that, because we're risking whatever we're risking, but we're almost never going to hit the maximum profit, and usually not even very close to it.
Yeah, that's always a good point to hammer. People look at these, these P&L graphs when they're learning about options, and they see, max profit, and they aim for that. And especially with the fly, very rarely are you going to max things out. There are so many different ways to take off flies and adjust them, and that's perhaps another episode, perhaps multiple episodes we can talk about with the adjustments of flies in particular, because people like to do them different ways. People view them different ways. Dan was just talking about a call credit spread versus a call debit spread. People like to do a lot of different things with flies and rolling and adjusting as things start to move. So perhaps that's a good future episode for the show here as well. But today's focus of our options drills is more along the time frame, which has, again, become a contentious issue of late. People have been hitting me up lately with all sorts of extremes about butterflies. People have been hitting me up saying, hey, I've been hearing a lot about expiration day flies and why I should do these. Other people have been hitting me up saying, I really like these ideas for very long-term leaps with butterflies. I have to say I'm not really overly enthused by either of those. First off, no matter what you're doing, long or short, if you're trying to get the move, you're trying to capture some premium with a fly, and you're doing it on expiration day, the horse is usually out of the barn by that point. Remember, a butterfly, what you're expecting to happen there, expecting that theta to kick in, you're expecting those spreads to start widening out. So by the time you get to expiration day, if you're trying to buy a butterfly, those moves have mostly happened. Those spreads have mostly widened out at that point. So there's not a lot for you to really capture there if you're buying it. Flip side, if you're selling it, most of the theta on expiration day is gone. That horse has already left the barn. So there's not a lot of theta left to harvest. What you end up doing is just putting on a lot of short premium risk for not a lot of reward at the end of the day. Remember that analogy I mentioned on the show last week about people who were short premium expiration day? You could just see it on their face. They were sweating profusely, popping tums, miserable, feeling every tick in the underline. That's going to be you if you're coming in and doing 0 data expiration flies on the short side. It's a difficult road to go down. Flip that around now for the extremely long-term butterflies. This has never been a use case I've really liked. Some people will argue for these, and I'm willing to entertain arguments on them. But again, what you're looking for on the long side of the fly, first off, is, and I don't think it makes any sense to sell long-term flies because that's just ridiculous. Look at all my statements I've talked about many times here about keeping your premium sales pretty close to the vest. You want to be able to collect that theta in a reasonable amount of time. If you're selling a fly a year out, you're not collecting anything for ages. And flip that around now for the long butterfly. Remember, you're long a fly, you kind of want those spreads to widen out. You want to get to those max width of those spreads. You want that theta to kick in and help you along that path. Well, guess what's not going to happen for a long time if you're buying a long-term fly? And that is there's no theta going to come out of that until you get really close to expiration, the last few months of that option's lifespan. And so buying a long-term fly, to me, has never really made a lot of sense. Now, people will play with that, Dan, and I'm curious your thoughts on this. People will try to play with that and say, okay, if I'm going to do this, then what I'm doing is trying to find, let's say, maybe a meme stock, for example, a name that you think is going to be another meme stock. So there's some pretty hefty call skew there. So you could do something like buy maybe an at-the-money call or a slightly out-of-the-money call, and then turn around and sell 2 pretty far out-of-the-money calls against it, trying to take advantage of some of that call skew. So you end up trying to get that meteor call for a much lower rate than you probably could normally. But then, of course, you have to go up this call skew again to buy that other call to hedge yourself. So you're still playing a lot in there. And that's kind of the argument I heard people say, well, if you have to widen out the strikes if you go pretty long term, but you can make something happen with that. And again, I've always said, at a certain point, when do those upside legs become vestigial? What's the point of them if you're selling them out a year and change? Maybe look at something else, but it's never been my favorite way to go. Dan, I know you're a short butterfly guy first and foremost, so maybe explain to our people like I just did why the short butterfly long-term makes absolutely no sense. And then flip it around. What are your thoughts on a very long-term long butterfly?
Yeah, Mark. So, I mean, as far as, well, here, let me just skip to the point on the meme stock thing that you were talking about. So this actually becomes really, really interesting because recently, as an aside, recently we launched Time Spread Genius, which kind of is the sister of Credit Spread Genius that we launched about a month ago. And I was talking with John, our head coach, and I was like, John, I'm putting together the boot camp for Time Spread Genius, and help me take a look at this. Why would I do this time spread instead of just simply buy a call? And it's just one of those times that I kind of had a brain fart in this situation. And he's like, well, look, if the stock doesn't go up, you lose everything on the call through time decay, but the break even for this with the time spread, and I know I'm a little bit off topic, but give me a minute. Your break even sits really pretty, and if the stock doesn't move, you might not lose any money. You might even make some. And it works the same way when you're constructing a butterfly, in which you buy maybe a slightly out of the money call, sell 2 of the guts calls at where you think the stock might end up at expiration, and then buy a higher strike call. That can make a lot of sense because of the break even, and because you don't, you could possibly be wrong and not lose any money, maybe even make money. So I still wouldn't go very long term with that because it's just silly. It doesn't make any sense there. There's lots of better strategies. If you're going to hold something long term, you're probably going to want to have theta on your side in one way, shape, or form, which you wouldn't in the way to construct it that I just laid out. So yeah, I mean, even doing it in the way that I just described, I would still keep that for sure under a month.
That gets back to kind of the initial genesis of this segment, what is really the proper time frame for a butterfly. And like Dan said, that's kind of where I tend to fall on butterflies as well. Now, butterflies are highly subjective. You talk to different people, they're going to have different use cases, different ways to construct them, symmetrical, broken wing, and also different time frames. But Dan and I think, are simpatico on this. The optimal use case that I have always found, and kind of maximizing all the Greeks that we're talking about and everything else, is somewhere within that 1 month time frame. If you're going long premium, maybe you go out a little bit, maybe you go out about a month or so, and you can buy that fly. But again, remember, if you get that move pretty quickly, you're not going to be too happy with that position because you're not really going to capture much of that. Same deal with that long-term fly. If you go to that meme stock XYZ, you go out a year, you buy your 1 year fly, you make it crazy wide. Still, you get a nice pop, the thing explodes. You're going to get some value out of that. Obviously, it's not going to be a bad trade, but you're not going to be happy, I think, at the end of the day. You're not going to capture a lot of that move because remember what happens when these meme stocks explode. The call wing explodes too. And then those calls that you're short 2 of farther out of the money, those are going to explode as well. And so you end up pocketing a small fraction of what you were hoping to gain, I think, with those. So that's another reason why I'm not a fan of long-term. That's why that 1 month time frame and within makes a ton of sense. You can even go into the weeklies, again, because if you're going from the long example, like, for example, in our fly, you're buying a 55 strike call, selling 2 of the 60s, buying 1 of the 65. So obviously you want that to move to 60 and sit right there. In our example, if you bought that fly and it was a 1 month fly and then the underlying shot up to 60 the next day, you'll be happy you made money, but you're not going to be super happy because guess what's happening? Those 60 calls that you're short, those are going to explode too, and you're short 2 of them. So your spread is not going to be worth what you think it is. You're like, oh, I hit my max profit point. I made $5. I'm out. I'm going to cash out for $5. Not so fast. You need those options that you're short. They need their time to decay. You need time for that spread to widen out and actually reach that max profit potential of $5, which is why too much time with a fly is actually not a great thing. It can actually be an enemy for you. That's what makes flies challenging. You have multiple moving parts. You need the underline to kind of land right where you want it to. And also you need to have the time right. And again, if you're too short, obviously you could miss the move and then that wouldn't work for you either. So it's a very challenging thing. You need to have enough time to have the move you're trying to capture happen, but not too much time so you don't really capture the move. One thing you don't want to do if you're trading long flies, listeners, you put that fly on, you do all the work, you spend the money, you're right, and you're right too soon. Because then you're left sitting there twiddling your thumbs, waiting for that theta to come out, for those calls that you're short to decay, and for your spreads to widen out so you can actually make some money on the thing that you put on. It's the analogy I've used before. You fly out to Vegas for, let's say, a week. I don't know who goes to Vegas for a week, but let's say you are. You don't even get to the casinos. You land at the airport, you pull a slot machine, and you win, I don't know, $1,000, something crazy. Obviously, that'd be a good thing, but also for the purposes of that trip, what are you going to do for the rest of the week? Are you going to sit there and not gamble the rest of the week? And so that's kind of the scenario you're in with that butterfly. You're kind of left sitting there twiddling your thumbs, waiting for that decay to come out. And then hopefully the underlying sits right there and doesn't move again. And I've seen it happen many times where you try to capture that move, you put the fly on, it's a long fly, you get the move you want, happens too soon, and then while you're waiting for that spread to widen out, the underlying comes back down and you ended up missing the move. And so in that case, obviously, you would have been much better off with just the straight option or maybe just a straight vertical spread. But again, these are the things you learn as you're trading flies. Short flies, same thing. You don't want to go too far out for obvious reasons. I wouldn't recommend anyone really going out and selling a ton of options 1 year plus out. That doesn't make a lot of sense. Even 6 months out, not really my favorite time frame for selling a lot of premium. You like to keep that stuff close to the expiration for obvious reasons. Decay happens the most rapid pace towards expiration. So you want to be able to harvest that. So if you're selling short flies, you definitely want to keep them very close to the fire. Dan, when you're setting up your short flies, what is your typical time frame? You doing them in the weeklies, a week and a half, daily? What's your setup?
I keep them under 10 calendar days, so about a week and a half. That just seems to be the real sweet spot where you start picking up on some of that theta, and I just find that they work out best that way.
There we go, listener. So there's your kind of refresher on the proper time frame for utilizing an option. Now you're going to search the web. You can find people telling you all sorts of different time frames. If you hear that, if you have questions, come back to us. We'll be happy to walk you through more examples of why we think this 1 month time frame is optimal for butterfly traders. Again, butterflies, very popular and a highly subjective strategy. Everyone has a kind of own approach to it. But for us, what we found that has worked for many years is both long and short, keep them within that 1 month time frame. And you're probably, not all the time, obviously, but probably going to be happy. Before we get out of here, let's do a quick check-in on our question of the week, a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Of course, if you're listening to this on demand, this will be our question of the week from last week. But of course, we're doing a double header today. So our live folks, this is our question of the week, which is raging right now, Dan, and a very apropos one, given all the, shall we say, market turmoil that's been going on out there. Market's kind of in the green mode today, back up north of 3,700, actually exactly at 3,700, up about 1.5% right now as we're recording, listeners. Let's see. It's like my VIX puts are looking a little bit better today, which is always nice. But Dan, our question of the week right now is, we asked you back in June, and we've been tracking all of our questions of the week, so I'd like to revisit them sometimes. And that's exactly what we're doing right now. Back in June, we asked you about your levels, and over 40% of you said that you were waiting until the S&P hit about 3750, which was obviously some levels we have hit previously. People like those psychologically important levels. You're waiting until S&P broke below 3750 before you wanted to start hashtag BTFD, and you're going to buy that dip. Now we're revisiting that. As we posted this back on Monday, the S&P was hanging out at 3660, so nearly 100 points below that. And we said, is this it? Is this the moment? Are you now back in? Are you buying back in? Are you waiting for lower levels? Or our third choice, you never got out. Dan, What do you think our audience is voting for, sir?
I am going to say that they're waiting for lower levels. Is what I think.
It's like you've been hanging out with our audience a bit or something, sir, because that is exactly what they're saying. 75.6% right now saying, you know what? 3660, not the level you were waiting for. They want lower, Dan. 17.1% of you said you're back in. So this was enough for you. You're diving back in. And 7.3%, this part I like less, saying you never got out. So I feel for you folks if you've been riding this all the way down. Hopefully you're listening to a show like this. We've taught you some techniques you can utilize along the way to, at the very least, mitigate the pain, hedge some of those losses, give you some ways to hopefully make that a little bit less painful. But 7.3% of you never got out. That's our question of the week over there at Options. If you're listening on demand, listeners, it'll be expired by then. It'll be the question of previous week. All of our live folks can get in there right now at Options, make your voice heard. And if you're listening to this show, listeners, you should be checking out at Options on Twitter all the time. Anyway, we know a lot of you are subscribers there, and you'll be able to see all the questions of the week and all the other great data we put out throughout the week. All right, Mr. Dan, that music means we come to the end of another extra special Options Bootcamp doubleheader. Man, we must love the folks. We did a live from Mastermind not too long ago. Then on top of that, the 200th episode spectacular. And then on top of that, another live from Mastermind. And now because we like them so much, Dan, they got a double header palooza. What more can we do for these folks?
Well, you know what? If anyone who is listening would like to give us a suggestion for a show, I think that would be kind of fun, wouldn't it? Sort of what do we call it? Lady Answer the People episode.
Sure, we love those. Send in your questions and send in your suggestions for shows. Maybe you have a different view on butterflies. We'll be happy to discuss it here on the show. So there we go. Send in your suggestions for all sorts of fun. And Dan, if folks want to send their suggestions directly to you, like maybe you should get off the show and never be on it again, or why do you always come on drunk? Where should they go? What should they do?
They should come over to my house, bring a case of Old Style. And they can surf on over to markettaker.com and they can hit contact us. They can hit join free and get some great options education content. They can even temporarily join our chat room for free and see some of the trades that I'm posting live real time every day.
There you go. Check them out. MarketTaker2Ts.com is the place to go. We got to get on out of here. For all of you listening live, we'll be back in a little bit with Mr. Overby doing a rare live huddle, a live episode, all questions considered episode of Options Playbook Radio. If you're not listening to that show, listeners, and you're listening to Bootcamp, check it out. You're doing yourself a disservice. Very much the sister program to that. For all of our live folks, you'll get live access to Brian today. It's very rare we get his compliance folks to let him come live on the network. So take advantage of those. That'll be coming up in a little bit. If you got some questions in the live chat for Mr. Overby, get them in there now. We'll be sure to talk about them in a little bit. All you folks listening on demand will get that on the network. And then, of course, we'll be back again next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.